So most homeowners are really shopping for one thing when they're getting their first mortgage or when they're shopping at renewal time, and that is the lowest mortgage rate. But that's not always how you get the best outcome, and let me explain why. The one thing I wanted to look at today is comparing somebody's scenario when they have a straight renewal versus how they can take this time and this as an opportunity to reassess their scenario and what they have going on. Um, so I'm just going to pull up a quick little budget here. Oh, all right. So the one thing that we're looking at um, is we're just going to compare two scenarios. You're looking at a 5-year fixed rate, and uh, you've got a 4.99 rate that's being offered, and you've got a 4.89. So at surface value, these two are looking like, hey, apples to apples. These are pretty much the same. This is an easy no-brainer, right? We take the 4.89. Property taxes and everything has been like, these are identical scenarios, right? Um, Really, the highlight here you're going to see a little bit lower. Um, but what I wanted to say is that the reason that rate ends up being the topic of conversation is it feels tangible. It's what we are sort of taught to ask about, right? All these commercials, everything we've always heard growing up, or anything that you learned is you take the lowest rate. What's the 5-year fixed rate? Can you get that rate any lower? We buy a vehicle, we want the lowest rate. You want that 0% financing, all that good stuff, which it makes sense. And a lot of times it's a good question. I think in many cases, what folks are really trying to figure out by asking that is how can I pay less? Obviously, right now things are pricey, right? Most people in Canada and I guess across the U.S. are experiencing things are tightening in terms of their wallet, their purse strings, and they want to know how can I make my paycheck stretch a little further. And the easiest way to make that happen is to pay lower each month. And the way I think I could do that is by taking the lowest rate in many cases, right? It's easy to compare mortgages between banks when you're just looking at that. And like I said, the banks advertise this very heavily. But the reality is that rate is the price and structure is the strategy, right? So if we take a look at these two scenarios, so like I said, we've kept everything pretty much identical. The only thing that's really changed between these two is the rates, 4.89 and 4.99. And when we look at these two scenarios, the real difference comes down to about $33.98 a month. Not going to make or break you in many cases, but not insignificant, right? But when we're really comparing things and we're diving into a mortgage for our buddy Bruce Wayne here, um, we're looking at many things: prepayment privileges, the portability of the mortgage, the potential mortgage penalty. Is there a bona fide sales clause? Is there a home equity line of credit? Or do you have the option to put one in down the line? This one right here, the bona fide sales clause, this is one that is always really good to make note of, and not everybody realizes that this is something that exists. But essentially, when you get one of these or oftentimes I should say, when you get one of these rock bottom low rate mortgages, they come with a catch. There's always a catch. And oftentimes, this is the catch. The catch being you're not allowed to refinance your mortgage within your term. Meaning, if you took a 5-year fixed rate mortgage, the market shoots up and you want to access some of that equity to whether renovate something or buy a vehicle or whatever you want to do, buy another rental property, you don't really have that opportunity because it's written in your contract. So this can be something that is a bit restrictive, and at surface value, you're like, hey, doesn't bother me. I'm planning on writing out my term, but the reality is majority, 3/4 of people do not write out the full term. But other thing we're going to highlight here are potential mortgage penalties because these two kind of go hand in hand, right? Let's pretend that we had no bona fide sales clause within the mortgages that we're comparing. But we're looking at potential mortgage penalties. Now, we've looked at a 5-year fixed rate because generally these end up being the lowest rate mortgages being offered. There are exceptions to every rule, but 3-year mortgages have been pretty good over the last 18 months. But in this case, the Bruce Wayne, our client, he wants a 5-year fixed rate. That's what he's been taught to ask for. So we've positioned this with a 5-year fixed rate just to highlight a few things. But when we're looking at these potential mortgage penalties, the way that these two lenders calculate their penalties differs. And we're not going to get into the nitty-gritty details of it. We're just going to take a look at high-level view. But we're going to say the higher rate comes with a medium penalty, and the lower rate comes with a high penalty. Medium, I would characterize this as $3,000 to $6,000-ish thousand dollars. High, we start getting into that $6,000 plus. Again, we're not going to get into why, but those are penalties that, if you get a $10,000 penalty to break your mortgage, that might eat into a significant chunk of the equity that you were really hoping to pull out for the kitchen renovation, right? If you had $50,000 you were expecting to be able to pull out, but $10,000 of that is eaten up by a mortgage penalty, that puts your whole plan into a bit of a jeopardy, and you've got to reassess and figure out where you've got to make those cuts. So this is one reason why we take renewal time as an opportunity to review all this stuff, right? Do you have any plans in the next 3 to 5 years to do any of these things? If so, should we be changing our term selection? Should we be picking a mortgage that is less restrictive? And then on the front end, if you're somebody who's getting into your first home, again, we look at all these things to say, this rate might be slightly higher, but is it going to restrict you long term, right? Maybe you're buying this home, you've moved to the city that you're in, you've got your first good entry level job, and you're saying, okay, I'm just going to build up some work experience, build up a resume. I plan on moving back to where I'm from in the next 2-3 years, sell the house. You kind of might want to position yourself with a mortgage that's going to have a lower penalty, right? That way you could maximize what you get on the sale of the home. So that's one way that we kind of want to assess the whole mortgage and figure out what makes sense. Now, the other thing that our buddy Bruce Wayne could do, if, for example, again, he was coming up for renewal and we're comparing 2 separate mortgages, the first question, like I said, is what is the goal? Are we looking to just keep the status quo? Everything is okay, cash flow is all right, we're just kind of getting used to having the mortgage, or have we kind of gotten used to this, and now we really want to accelerate our pay down, right? Maybe this is something that has just been irking you. You don't like the idea of having a large amount of debt hanging over your head. And you've got yourself a good job, you're pretty good with your money, and you're saying, okay, I want to hammer down this mortgage as fast as possible. So one thing we can look at is implementing some strategy. And what I mean by that is setting your mortgage up in a way that allows you to pay this down as fast as possible. If that is the goal, we can set this up so that you don't have to think about this, right? Because the only real way to pay down your mortgage faster is to just pay it more often and to pay with larger amounts. You got to do this more frequently, right? So if we decide to put a little more strategy into the mortgage pay down, what we really end up looking at is, I'll just skim over some of this because this is a real scenario, but we've changed the name so that it's our buddy Bruce Wayne. So in Bruce Wayne's scenario, he has an extra surplus at the end of each month of money. And in many cases, what folks do with this money is they, either squirrel it away into a savings account, or they squirrel it away into some sort of investments, or they just simply spend it. That's in many cases what happens. You've got extra cash, maybe you get the new vehicle, or you buy the new furniture, the new clothes, whatever it is. But in our scenario here, Bruce Wayne really, really wants to pay down this mortgage. So when we take this extra cash flow and we account for this with this new structure, he's actually going to save 9 years and 7 months on his mortgage. So that's not insignificant, right? Um, the projected lifetime savings in interest is about $125,000, which is crazy. And if we look at his current path versus the accelerated path, we're going to see that, after 5 years, the current mortgage is going to be about $299,720. Now I know these numbers don't match what we had on the other spreadsheet. The other spreadsheet is, it's not quite this scenario. This is a real life scenario. Um, his current mortgage after 5 years is going to be $299,720, and with our strategy, we're going to be at $210,878. We fast forward another 5 years, and your current mortgage is two and a quarter, and we've actually dipped below $100,000. So 10 years down the line, you could have a mortgage that's under $100,000, and you can say, okay, you know what? I'm going to pause. I'm going to now reassess my scenario, or even at the 5 year mark, you're going to say, wow, we've hammered down this mortgage. We've got an extra $80,000, 89, in equity. Maybe we reassess. Maybe we make that renovation. Maybe we sell, right? But the reality is every couple years, you take this, you reassess, realign, and you figure out what you want to do moving forward. And that way, if you wanted to keep chugging along, year 15, and boom, at the 20-year mark, you have paid this down slightly earlier, right? And that gets you mortgage free incredibly fast. Let's stop sharing this. So that is a little bit it's a little bit of a behind the curtain about how we can look at scenarios, assess them top to bottom, and say, okay, we've got our game plan for renewal. We've got our game plan kind of when we're buying the first house, and then depending on what somebody's strategy ends up being, we can pivot and adjust accordingly. So let me know what you think. I do have a mortgage renewal checklist that you can actually download. I'll put the link in here, and love to hear some thoughts on this.